Welcome to the Founderville.vc podcast. This is a podcast where we talk to founders and entrepreneurs. We talk to innovators. We talk to anybody that supports founders. Today, we're joined by a great friend of the podcast, a staple inside of the Greenville entrepreneurial community, Mr. Matt Dunbar with Vicinity Ventures. Matt, welcome to the show, bud.
Thanks, Shay.
It's good to see you. I'm glad you're here.
Glad to be here.
And thanks for making the drive over. It's a little outside of the way.
From downtown.
It's a long way, Pelham Road. It used to be 5 minutes.
Territory.
Yeah, now it's 20 minutes from downtown.
It was easy today, so.
Well, how you been doing?
Doing well.
Yeah,
doing well. Keeping busy.
I
know you are.
Busy. Yes, we all are at this moment in time. Crazy times and whatnot.
Indeed.
What tell us about, for the few people that don't know Vicinity in Venture South and what you've been building for the last decade and a half, maybe 15 years.
Yeah.
Tell the audience about it and what you guys are working on and sort of what you're doing now.
Yeah. Well, thanks for the question. So I'll start with Venture South. That's the original early stage angel investor network that we built, starting with the Upstate Carolina Angel Network here in Greenville. It's grown to a regional platform where we invite folks who are interested in backing entrepreneurs that are raising capital at an early stage to try to grow businesses in the Southeast. We're focused on the Southeast.
Okay.
We run a network and a process to identify those companies, diligence those companies, and then give investors an opportunity to participate in investing in those companies. So we run that whole process and structure on the Venture South side.
Right.
Last year, we actually merged with Vicinity Capital, which is another player in the entrepreneurial ecosystem here. That conversation actually started around technology. We wanted to explore leveraging the technology they built for their business to support the work that we were doing.
Okay.
And the more we got into that conversation, the more we saw some synergy with the business they had built, which was really based on the idea of leveraging the regulatory regime that was created in the Jobs Act back in 2012 after the financial crisis to create equity crowdfunding platforms. So they had built a Reg CF, Reg crowdfunding platform that was focused on trying to help local businesses raise money from their community, whether that was their neighbors, their customers, their fans, their supporters, similar to sort of the traditional crowdfunding markets. But now instead of just pre-selling a product, you can actually sell ownership in the business under this regulatory regime. So they built Vicinity Capital to do that and had gotten a foothold, raised money for several companies in Greenville and beyond. And again, the more we started to think about our two businesses, we saw a lot of opportunity to create synergy there around a couple of different things, not just the technology and the platform being all in one for folks that might be interested in supporting businesses.
Right.
But we already had a network of investors distributed across the Southeast. We could plug in their platform into more communities than they were already active in. And then we could give our investors who want to support early stage companies, who also run into the challenge, which I'm sure we'll talk about, is when we invest in these startups, they're obviously highly illiquid. And the time to liquidity can be longer than you would like it to be at times. And in the way our model works, if you're an investor in one of our markets that maybe doesn't have a local tech deal that comes through the pipeline over a year or two, you might still be interested in supporting companies in your own backyard. Vicinity gives us the ability to support different types of businesses that wouldn't raise traditional venture capital, but they might be able to leverage their community supporters to raise more traditional forms of capital to support their businesses, which could also potentially generate liquidity faster than our tech portfolio.
Got it.
So blending the two portfolios and the two investor bases on an integrated platform made a lot of sense to us.
I think it makes a ton of sense.
And so that's what we put Venture South together with Vicinity Capital to form Vicinity Ventures.
So you've had a little going on over the last 12 months.
A little.
I think, look, strategically, this thing makes all the sense in the world. There's no doubt about it. I mean, you guys are a staple of entrepreneurship in the Southeast. I mean, you started in Greenville, South Carolina. You guys have built something. Your brand is super well known here. I mean, it's amazing what y'all have built over the decade or decade and a half.
Well, thank you. Appreciate that. It's a lot of hard work, but
how the heck? I don't even know this, honestly. This is a genuine question. Like, how did you get here? Like, how did you guys? Because it started as UCAN, if I remember correctly.
That's right.
When did you get involved, or did you create that?
Yeah, so I'll give you the backstory, and I'll try not to bore you with too many details, but we started UCAN. I shouldn't say we started it. In 2007, a group of investors in Greenville got together and started to explore the notion of creating an angel investor network.
Okay.
Some of that was supported by the chamber and their brand new effort, which was called Next at the time. So John Moore was running point on that effort. There was an exploratory process to decide, could we start an angel investor network in Greenville? What should it look like? So they did a lot of homework, and they got several business leaders in town involved. The two ringleaders were Tim Reed and J.B. Holman.
Okay.
So that was going on in mid-2007. SC Launch had recently been created, so they were creating a pipeline of more deals in the state. The angel exploration effort was underway. Fast forward to early 2008, there was pretty good momentum behind that effort. They wanted to formalize a group, but they decided that the way they wanted to structure it, which was the right way to think about it, rather than asking a volunteer to manage that, they wanted to hire somebody to run it. January of 2008, I was based in Atlanta. I had gone to Clemson undergrad, was an engineer by training, worked in the industry for a while, went back to business school, did some consulting for a few years in Atlanta.
Okay.
I was ready to get out of Atlanta. I was newlywed, wanted to come back home to South Carolina, start a family. So I started looking for opportunities in the upstate, really liked what I saw in Greenville and had several friends who were based here. So I came to visit a few times. I showed up to an event that the Clemson Business School was hosting in downtown Greenville. They were just starting to make their efforts to get more active in the Greenville business community through the business school.
Yeah.
I go to the event, don't really know anybody in the room, so I just get in line to get lunch, start chatting with the guy next to me, who turns out to be J.B. Holman, who was leading this effort with the Angel Group. So we chatted a bit. He asked what I was up to, and I told him I was looking for something interesting to do. I knew I wanted to do something more entrepreneurial than what I had done previously in my career. And so we chatted a bit, and he asked me what I knew about angel investing. And I said, well, a little, but not a lot. I haven't done it, but I'm familiar with it. I'd been exposed to it through business school. We chatted a bit, and it became clear at the end of that conversation that they were really looking for somebody that had a venture capital background, which I did not have at the time. So he said, great to meet you. Good luck. We'll see you around.
See you around.
See you around. So that was January of 2008. A couple of months later, I was still looking, had not decided yet what I wanted to do. He called me back and said, if you're still interested, let's talk again. We haven't yet made a decision, but we want to get going. And if you're still interested, let's have another conversation. So I came back, we met, and effectively I said, well, we really haven't found any other venture capitalists running around town, so we might settle for you if you're willing to take it on. And so I thought this would be a great way to get plugged into the community. I really wanted to be around entrepreneurs, meet a lot of great business leaders. Yeah. I really thought at the time this would be a great way for me to find a startup that I could go work with.
Oh, no kidding.
I wanted to help grow a startup.
Yeah.
So we come and start the group in April of 2008.
Right.
You may recall how the rest of 2008 went. That was
what I was just thinking as you were talking about the timing.
Pretty challenging year to get started, but the silver lining there was that we had not already invested. Had we made investments in 2006, 2007, they would have surely tanked and gone belly up.
Right.
But we had not yet deployed capital.
Okay.
So despite the challenges of the financial crisis, it bought us some time to try to figure out, okay, how do we develop a process to do this? How do we find deals? How do we deploy capital? So that actually, I wouldn't call it, still not the ideal way to start a group, but it did buy us some time.
Right.
So we got going 2008, started to build our processes, and then the long story short is that over the course of the following 2 or 3 years, as people dealt with the aftermath of the financial crisis, it started to become sort of the conversation of the day in entrepreneurial circles that, hey, if we look at the data, all net job growth in the U.S. comes from young companies that grow fast. Around that idea, you had these accelerators forming. So you had Y Combinator had just gotten started, Techstars, and then everybody wants to create an accelerator, which is great. But if you're not in Silicon Valley, you need to find some capital to support those folks. And so it didn't take long before we started to get inbound questions about how do you start an angel group, because we've started an accelerator and we need to raise some capital to support those companies. So we started to have more and more conversations with folks around the state and around the region about how to do that.
Okay.
And so it started to become interesting for us to think about what if we could scale this model, because as hard as it is, as we know, to get an entrepreneur from 0 to 1 and then to scale it, that's a very tough proposition. We know the failure rate in startups is high.
It's huge.
So the chances of us having enough deal flow in just one town in South Carolina to really build a substantial portfolio didn't seem very likely.
Don't
at
I
the
know
time.
it? It's tough.
Right, it's tough. So we thought, well, we can build a broader portfolio by finding the best deals in the region.
Yeah.
And if we can aggregate more capital around the table to support the best deals we find in the region together rather than just one-off city by city, that should be a win-win for everybody. And so we started to scale the network and bring other markets into that model.
Okay.
And so that's when we went from the upstate Carolina Angel Network to briefly becoming the South Carolina Angel Network in about 2013.
Right.
But one of our first groups was in Asheville, North Carolina, and then we were moving to Charlotte, and so pretty quickly that name was obsolete. And so in 2016 we rebranded as Venture South.
Okay, got
and so
it.
that's where that name came from, and sort of the evolution from one group to a regional platform.
That's fantastic. I didn't know how you sort of found yourself involved with founders in this capacity. I mean, at this point, you guys have deployed a lot of capital, seen a lot of companies. What does the portfolio look like in terms of number of companies? How much capital have y'all deployed? What does that look like?
Yeah. So as of this Friday, we will invest in our 130th portfolio company.
Dang, that's awesome.
I believe we have right around 75 of those that are still active.
Wow.
So the rest have either shut down or exited.
Yeah, sure.
So we still have a very
big portfolio.
It's a big portfolio, a lot to keep up with.
Yeah.
And as you know, it's a wide spectrum of success and skirting with
everything
failure.
in between. Yeah.
Everything in between. And that will put us pretty close to we won't quite cross $99 million when we close that deal on Friday, but we'll be close. And so we think we'll cross $100 million sometime in the middle part of the year.
That's amazing. Venture South is easily one of the most active funds in angel funds in the country. Am I right on that?
We are.
Yeah,
we are. We
thought so.
tend to be in the top 10 in terms of dollars and deals and size.
What have you? I mean, maybe before we get into like what's happening now in the market, I mean, what have you experienced in terms of the change maybe over the last 10 years as you really started Venture South and really started sort of collecting the network of Charleston and Asheville and Charlotte and these other areas, the way money gets put to work? In other words, think about it 10 years ago, the way y'all did it and the process you ran versus maybe over the last couple of years. How has it changed?
Yeah, it's a good question. At the core, our process hasn't changed a lot. Part of the idea of structuring our network the way we do is that we leverage the expertise and insights of that network to help us identify and evaluate these companies. So it's not just me and Paul and Charlie, my two partners at Venture South. We're really inviting investors across the network to contribute their experience to help us evaluate opportunities.
Sure.
And we've had that model from the beginning. Okay. Obviously, as we've grown the network, that's given us access to more folks who can participate in that process. And so that core approach has worked for us for a long time. Now, we're always tweaking at the margin and trying to figure out ways to be more efficient or more thorough. Nowadays, how can we leverage AI to help us do a better job? That's a whole nother conversation we can talk about. But that model hasn't changed a lot. What I would say is that I think, as you alluded to, sort of the macro environment changes a lot. Whether that's, just the appetite for venture, pre-COVID, post-COVID, post-interest rate hikes.
2021, 2022.
Yeah, exactly. Yeah. And then also the nature of the market in terms of how deals get structured. As you know, nobody knew what a SAFE was. It hadn't been invented yet when we started, this enterprise. And now that seems to be the default for most early stage founders when they're trying to raise a seed round. And so we have some concerns about that structure because it doesn't really give us some of the protections that we would typically expect on a preferred equity type round, which is our bread and butter. Yeah. And so we have to adjust to the market and be aware that, obviously, as the market has grown, we're not the only form of capital that folks can raise. And so we need to be competitive, and we want to be fair to entrepreneurs, but we also need to be disciplined and try to help particularly first-time founders who haven't been around this ecosystem, how to think about structuring not just for today, but how that impacts downstream how you can or can't raise capital and what the implications are both for the investors and for the founders. And a lot of times I think founders just don't yet have enough experience to understand some of those implications with some of the structures that are popular.
It's such a good point. I mean, I think I spend more time with founders and have over the last 3 years trying to help them understand what does it mean to build sort of the capital stack and think through the future. The way you raise now impacts your future raise, and here are the things you have to think about. And it's not a knock on them. They're not necessarily naive. They're just inexperienced, and they don't understand it. And they're reading TechCrunch and they're reading all these things, and they think that's real, and that's 1 in a billion. You know what I mean? It's unfortunate, I think, in some ways how Silicon Valley has celebrated these $100 million raises at a $1 billion pre or whatever it is. It doesn't matter, 2 on 20 or 5 on 20 or what. It gets celebrated and then it's advertised and marketed, and a lot of founders think that's what it is. And that's not what it is. That's this microcosm of the market with a highly unique situation and scenario, which is very rare. It just is. And that's not real life in many cases. And it's hard to have that discussion.
It really is. So for that reason, we spend a lot of time trying to offer both to our investors who may be new to early stage investing as well as to entrepreneurs when we have a chance, a lot of education. So for instance, to this point, we developed a course on understanding cap tables so that a founder hopefully learns how, again, not to just think about, okay, I just want to find a term sheet and think about this particular negotiation and this particular deal and I just need cash. To be able to actually put it into a model and understand, okay, if I make this decision today, here's how that's going to impact the decision I have to make for the next round and the round after that, and then what that means at exit, and understanding how the waterfall works. And just because you own 20% of the business at the time you exit doesn't mean you're getting 20% of the proceeds.
No, definitely not.
If you don't understand how you structured the preferences and everything associated with the terms that you've signed along the way. So a big part of what we're trying to do is draw in folks into the ecosystem who are interested but maybe haven't had a platform or a way to access or understand how this ecosystem works, so that investors can get more comfortable writing checks. And so entrepreneurs can learn better how to approach not just the fundraising part. That's hard, but that's really where the fun begins. The real hard part is growing the business once you've raised the money. And so
that's step one.
How do we think about helping these entrepreneurs prepare and have the best chance of success going forward? So we spend a lot of time on both sides of that equation.
You guys do a great job on the education component. I remember watching you speak. We were over at the Next Center. It's probably been a couple of years, and you did your slide had this case study. I think it was like a healthcare related company out of Nashville, Tennessee, that had a multi-$100 million exit, but like the seed and Series A maybe, I don't want to say they got wiped out, but it was like this massive gap in what you think they would have gotten. And I remember thinking, like I had a fundamental understanding of it, but kind of looking around the room, it's like I don't think they understand how this happens and how it can easily happen, because I think the company went from raising a couple of $1 million and where sort of private equity or a Series C group got in, and it was like a $50 million round and a $100 million round.
Those preference stacks,
they add up.
Yeah, they add up. And again, a lot of folks don't realize how much that raises the bar in terms of what the outcome has to be in order to really return capital to folks farther down the capital stack.
There's a lot of education to be done. I think you guys do great work doing that. We try to do that work. Next does that work a lot. There's a lot of groups across the ecosystem trying to help. I mean, I think unfortunately we're disadvantaged in South Carolina in particular to some degree. There's, I joke it's the venture capital black hole. Thank God for Mississippi, although maybe they're beating us at this point. I don't really know.
I don't think so, but
it's probably close. There's, that said, there's so much opportunity. We see so many great founders and so many great companies coming out of this state and this region. I think it's an underserved market. I don't know why more investors in Atlanta and Raleigh and some of the outlying markets don't come here and just see. And that's, for me, that's frustrating. I want to see these companies succeed and thrive and build this flywheel that I know we can build. Tell me, what are you guys investing in today in terms of sort of what's a typical investment look like in terms of sort of size, scale of the company, segment? Like, I know you guys are generalists.
We are.
Yeah.
Yeah, so we're agnostic as to industry. We're really looking for deals that we think can generate a venture class return. And when I say we, I'm focused on the venture south side of the business. We can talk about the Vicinity side of the business separately. But we'll consider any industry. Again, because of the breadth of our network, there's probably somebody in our network that can give us some insight on just about any industry that we would see. But not surprisingly, venture class returns tend to come from a few different industries and verticals. And so that's where you would see most of our deal flow. Certainly software and tech is a big part of it. We do a fair amount of life science and health tech as well. We're also not afraid of hardware, in the right situation. Now, we wouldn't probably invest in something that's a super capital intensive hardware play, just because we don't have access to, real deep pools of capital. But if it's a diagnostic device or something that's relatively light or like manufacturing, we can look at that. And what we're really trying to do is build a portfolio that is diverse across industries and segments, but that we're effectively underwriting each of those deals such that we think there's a chance, and obviously we know that the bet will go against us in a lot of cases, but if things go according to plan or reasonably according to plan, we think there's a chance to generate a 50% rate of return on our money. That's sort of the benchmark because we know we're going to have a bunch of failures. So we've got to blend the 50+ returns with the zeros and hopefully end up with a blended return that's somewhere in that 20% range for a venture fund, which is typically what you're looking for. Yeah.
Well, how do you coach angel investors? And what I mean by that is the angel investor community, the folks that are a part of Venture South, they're successful, they're smart, they've obviously made some money, they want to put money to work, they care probably, they want to support the ecosystem. But I'm sure there's some that just want to pick and choose. Some they want to put 25 grand in this one and 100 in this one. Others are just all spread 25 in each one or 50 in each one. How do you think about coaching them to think about it for like a new angel investor?
Yeah, it's a great question, and I wouldn't say that we necessarily have a formula that's the right formula. We want to be sensitive to the fact that everybody's got their own investing style and their own objectives and preferences. But the main thing that we try to communicate to folks is that you need to go in eyes wide open that this is a very risky asset class, so you cannot invest money you can't afford to lose because the base rate is that most startups fail. So you should expect when you write the check that you're never going to see it again. So don't invest more than you can afford. Exactly. And because of that dynamic, it's really, really hard to predict which ones are going to win and which ones are going to lose. Even the best investors in the world have very high failure rates. So you need to diversify. That's just a part of how you need to think about approaching this asset class. That's why funds are structured the way they are, to give a sufficient diversification in a given portfolio to manage for the fact that there's going to be failure. So we tell folks the way our model works is the minimum commitment to participate in any investment is $5,000. So if you want to build a portfolio of 10 to 15 positions, which is sort of the minimum we tell people you should really think about to give you sufficient diversification, you need $50,000 to $75,000 of available capital. You don't have to invest all that tomorrow. You can invest it over 2 or 3 years. But you really want to be thinking in those terms to give you a minimally viable portfolio to give you the best chance of actually making money in this asset class. So we want you to know that going in. The other thing you have to realize is, as I alluded to earlier, it's very illiquid. So if this is money you need back in 12 months, don't invest it because we can't go trade these stocks on the public market tomorrow because they're not publicly traded. These are privately held positions. And we really, because we're minority investors, not like a private equity shop that takes a majority control, we don't ultimately control the exit. We have a lot of influence, but we don't fully control it. And of course, we need some time for these companies to build enterprise value before it's really going to be worth it to sell the companies. So we tend to expect that our hold period on a position would be 3 to 5 years. That's our target. Sometimes it takes a lot longer, but we're, again, trying to communicate to investors it's illiquid. You got to diversify. It's very risky, so don't invest money you can't afford to lose. But then once you kind of have those baselines, then it's really kind of up to the individual investor to decide how they want to build that portfolio. Some of our folks are very diversified, and anytime our group is doing a deal, they're going to throw $5,000 or $10,000 into it. Other folks are more focused on an industry they know or they like, that they have experience in. Other folks say, I really like that, and I want to pick and choose with some of my money, but I also understand the diversification principle. And so with some other money, I might put that in one of our sidecar funds.
Okay.
Our sidecar funds are a passive way for those investors to say, okay, I want to automatically diversify into anything that the network does.
Yeah.
And so we have a mechanism whereby if at least 10 of our investors collectively invest $100K in a deal, then our current sidecar fund is going to co-invest alongside the network.
Okay.
So with that fund, you can actually build a similar size portfolio of, call it 15 to 20 positions with a smaller overall check size.
Man, that's great.
Because our minimum commitment to our funds is 25 or 50K, depending on whether you're a member or not.
Sure.
And so that's a way to automatically, passively diversify. So you can index this asset class through that vehicle, while you also, if you so choose, can double down on things you really like.
The deal, I love it. The business model is fantastic. That's why y'all have had the success that you had over the last 15 years, no doubt about it.
We think that approach, seems to work well.
Yeah.
Obviously, it all boils down to how the portfolio performs.
Sure.
So,
different times right now. I mean, I think we're in a situation where venture capital is harder to come by for the founders. Maybe let's switch gears and talk about from the founder perspective, and then maybe we can get to Vicinity before we run out of time. What are founders seeing today? If you're a B2B SaaS founder, I'm not trying to rain on the parade, but B2B SaaS founder with 50,000 ARR and a couple of 3 or 4 or 5 employees in total through consultants and trying to hit the B2B space, what does that look like today, do you think?
Well, I think it's really tough right now for a couple different reasons. You've got sort of the macro backdrop of, what has been a fairly challenging venture environment since the post-COVID money printing phase of 2020, 2021, when things just went through the roof, so much capital sloshing around, easy to raise money. Fed starts hiking rates early 2022 and very aggressively, which really slowed down capital markets, particularly on the M&A side, which means less liquidity flowing back into the market, less capital available to invest at the early stage. So certainly there's still been deals happening, but it's been a much tougher road to hoe for companies trying to raise capital over the last 3 or 4 years.
Sure.
I would say it had been loosening up. Late 24, 2025 was better.
Yeah.
Kind of came into this year with, pretty, I think, optimistic expectations around how the market was going to continue to trend in that direction. But now there's a couple of things that have changed since the beginning of the year. I think one is, this whole idea of AI just consuming everything, the SaaSpocalypse I'm sure you've read about, where, if these enterprises are cutting out a lot of staff and they don't want to pay for subscriptions on a per seat basis anymore, partly because they don't have as many people and partly because they can build AI, use AI to solve the problems that those SaaS products were solving. Yeah. That's a real threat to a lot of those companies. And makes it really tough as an investor to think about how to allocate capital in this dynamic environment where that's changing so fast. Really hard to get a bead on what's really defensible, what's not going to be competed away immediately. Yeah. How do you build a moat in this environment?
It's scary as an investor.
It is.
It's a scary time as an investor, and any investor that says it's not is full of it because it is.
Absolutely. And it's just hard to anticipate what the net fallout is going to be. And that's all, in venture, you're always making some educated guesses about the future.
Right.
But I think this is a particularly uniquely disruptive time with AI and trying to anticipate what the impacts will really be across the board, not to mention just how does that impact your SaaS business model.
Sure, right? no doubt. I mean, it's not a week goes by that there's not a layoff announcement from whether it's Microsoft or whoever. Maybe Vicinity is the only one not laying off, but essentially everybody's laying off. And they're using a variety of excuses as to why this is happening. But, I mean, we all know it's AI related. I mean, I think their margin expansion is going to be enormous over the coming years. Then I'm a technical neophyte, yet I'm using a tool like Manus that Meta bought that is essentially a full-time researcher for me and a marketing person for me.
Yep, absolutely.
And it's like, if I can use this tool and get this type of result, then like a B2B SaaS company, I can't imagine what they can do. So it makes it really difficult to allocate capital. I think a lot of founders probably don't understand as fiduciaries trying to put capital to work in the very best places that we can. It makes it super difficult. Thus, we move a little slower right now for a number of reasons, not the least of which, like I said, it's scary times.
Yeah. Well, then you add a war on top of that, and oil prices, and what are the impact's going to be. It's just hard to anticipate. And I do think I'm very bullish long term on sort of the net impact of the technology, and even if we have a white collar apocalypse to go along with the SaaS-pocalypse from a jobs perspective, I tend to think that like every other new technology wave, there will be new opportunities and new jobs created. Yeah. But I think this may be more disruptive than some of those have been.
This is going to be
an interesting transition.
I think so too.
And so that's a challenge for us trying to think about how to deploy capital. But I will say we're still deploying capital.
Yeah,
we're still finding companies that we think either have some defensibility or they're operating in a space where maybe they're a little bit less susceptible to just pure AI software disruption, or people that have a unique. I do think if you can build a unique moat around a really valuable data set, that can be super valuable.
Proprietary data set.
Absolutely. That something you can license out to the AIs that need that data. That's really interesting. So it's not as though there aren't still places to deploy capital. I just do think particularly in the traditional software lane, it's really, really tricky right now.
Yeah. Don't come to me with a brand new CRM idea.
Yeah, probably not going to get very far with that.
Right, not going to do that. But there's still capital being put to work, y'all. So Venture South's a great option. Let's switch gears in the few minutes we have left. Talk about Vicinity.
Sure.
And what is Vicinity focused on? How do people access Vicinity? If I want to invest in some of these deals, how do I do that? What does that look like? And is Vicinity in more than one market? Is it Greenville or?
Yeah, great question. So to distinguish between Vicinity and Venture South, one of the great things that we can do with the Vicinity side of the business is that it's public facing. So because it's regulated under the crowdfunding rules, they work through a compliance process where any deal that they put out to the market has been through a regulatory regime that makes it such that you can talk publicly about those deals and attract people to come consider learning about those opportunities. Right. On the Venture South side, we operate under a different regulatory regime. These are all private deals. We can't market them publicly. Right. So we're only focused on accredited investors on that side of the business. So you won't hear us or see us talk about deals we're working on before they're closed. We can announce it once we've closed the deal, but not while we're raising the capital.
Right.
On the Vicinity side, we're trying to get anybody that might be interested in supporting a local community deal engaged and involved. So that could look like a lot of different things. A couple of examples in Greenville to start with are we talked earlier before we started recording about Trueline, new music venue downtown Greenville. They leveraged the Vicinity platform to raise quite a bit of money here in Greenville, several $1 million here in Greenville from local music fans that want to be patrons and supporters of that venue. And so excited to see that business go live and launch later this year. We are getting close, knock on wood, to launching a raise for the Greenville Triumph and the Greenville Liberty, the Greenville Pro Soccer organization, building a new stadium down the road in Malden. Really excited about that project. They want fans engaged and supporting the team. So you can become a pro sports team owner by going to the Vicinity platform. Right now it's not live. You can indicate interest, and then we'll follow up once we flip the switch and we can launch the raise, which we hope will happen in the next couple of weeks or so.
Right.
So those are just two examples, but then we've got everything from an apparel brand in Chattanooga, a beard balm brand in Rock Hill.
Love it.
We're working on a project with an electric boat company based in South Carolina. That's really, really cool.
Are they in Charleston?
They are.
I think I've seen. Okay, I know this company.
They are. Yeah. And so the beauty of that side of the business is anybody that has a pathway to a really excited or committed group of fans, supporters, built-in customers that you haven't yet been able to deliver a product to, that you think might be interested in being a part of your journey from a financial standpoint, you can leverage the platform to do that.
It's an amazing thing.
And I have to defer to Josh and the team on the Vicinity side, around some of the particulars of what might fit or not. But generally speaking, anybody that wants to engage their patrons or supporters in their fundraise, this is a great way to do it. They can really walk you through the various options. There are a lot of different ways we can structure those deals.
Yeah.
And for an investor, again, back to our earlier conversation, a lot of those deals are structured in a way where you might be able to generate liquidity from that investment much sooner than you could with a venture investment.
Sure.
and you might also get some perks. So
take some swag, maybe
some swag, maybe a few concert tickets
Right.
if you're a supporter of the music venue, that type of thing. And so it's a really creative way to help what we call community deals that are less about scaling to serve the world with a software product and more about engaging a local community. Give them a great new tool to be able to access capital.
Yeah, I mean, I love it. We love it. We're investors in Vicinity and have
thank
been
you.
for years, and fired up about it. And love the strategy that Josh and John had from day one. I mean, I think I had Nicole Johnson on the podcast maybe a month ago or whatnot, and we just released it, and they succeeded in raising capital.
Right,
And
right.
that's the perfect example. It's a local brand. It's a national brand, but it's a local company. Cyclists that care about Boyd in the company can invest and be a part of it. And I think with Greenville Triumph, I mean, good Lord, if you're a soccer fan and you're living in Greenville, hopefully I'm not like promoting this thing. I think it's legal.
Yeah, that one's perfectly legal. It's public.
I think it's just a great way for a fan to put $5,000 to work and be like, I'm a part owner.
Absolutely.
Like I own part of this thing alongside Wallace and the rest of the investors.
Absolutely.
And I'm a huge fan and I love it. And I think there's so many opportunities to bring capital to work, right, and support local communities and markets and businesses in that way. That's
Absolutely.
super unique. So it's very cool.
Yeah, we're excited.
Well, dude, this has been awesome.
Thanks for
I
having
haven't looked at the clock, but I have a feeling we've been talking for about 45 minutes.
Probably
or
so.
So,
Yep.
thanks for coming out again.
Yeah.
I appreciate it. And thanks for all the work you do in Vicinity and Venture South. You guys do for the ecosystem, for the network here, everything y'all have done. You put 15 years into it or more. I think it's more, actually. I keep saying
more.
15. Yeah.
My
Coming on
hair's
20.
My hair keeps getting whiter.
But it's you've done a lot for the ecosystem personally, and I appreciate that, what you've done, and I appreciate what you guys continue to do.
Well, thank you, and likewise, appreciate all the great work you guys are doing at Founderville.
We're trying. We're trying. That's for sure. All right.
Good.
Well, Matt Dunbar with Vicinity Ventures. Did I get that right?
Yep.
Am I saying that correctly?
That's correct.
I think that's a brand. So anyway, this is Founderville.vc podcast, and we are over and out.